making the market easier to understand. We're going to do that right now. And let's start out with what happened over the weekend with the oil prices. Now, remember, last Sunday, oil prices went up $77 and they backed up. And then this Sunday, with the attack over the weekend with the nuclear facilities, oil went up again, but didn't go up and hit that $77. So let's go through oil here. What can we expect of oil? Well, XLE is the symbol, XLE. I also like to trade XOP, but XLE is the symbol. So again, you got to be careful. You should be selling into these oils, and you need to be careful because it could just do the opposite. If all of a sudden they talk about peace and the war stops, oil can tank. So you got to be very careful. So sell into it, taking profits, and then readjust your stop with the balance of shares you keep. Now, and do the same thing with the dollar. The dollar, as you can see, has been tanking, right? Look at that dollar. That is really tanking. And we all know that, the dollar, the weaker that dollar gets when we import stuff, it's going to get more expensive. So do the same thing. Make sure if you're shorting this dollar, at some point there's going to be a great opportunity for short covering. But that could change overnight, so make sure you're selling into your dollar if you're shorting and just adjust your stops. Now, what we've been finding out about, again, if you take a look at the S&P, there's very bad breath in the S&P right now. And the S&P, even though we're up about 9% in S&P, we have bad breath, which means there's many more stocks are underneath the 50-day moving average, okay, then they are above the 50-day moving average. So that's not good, all right? And there's few stocks that have relative strength. Now, the stocks that have been having relative strength that we've been following is like our VST. That's been doing really well for us. That's up about 13%, I think it is. And then we also have GRV. No, that's up. They're both up about 37%. Look at the rally on that. These had great relative strength. And the banks are trying now to move out with some relative strength. Okay, so I keep my eye on the banks because the banks are, they will lead this market and will take the S&P up through that February 19th high that everybody's been looking to break out. So the banks have kind of taken over because if you look at the S&P, we've been going sideways here, okay? If you look in the last 3 months, we've been in this narrow trading range of about 4.6%. So something needs to break it out. And what needs to be breaking out, I believe, are the banks because the banks seem like they're taking the lead right now, okay? So those, and we're in the banks ourselves, JP Morgan and Citi, we're about 16% in those. Now, as far as the NASDAQ stocks, I like to follow XLK. If you look on the chart, XLK, if you look at the Qs, okay, you can see the Qs are more expensive, but they're not that much difference. But if you take a look at the holdings in the Qs, compare the holdings in XLK, I prefer XLK, but it doesn't really matter. Now, there's going to be a very important on XLK. Again, we got a support right around 235 we got to watch. And then the next one is the 200-day moving average. If they break both those, we're going lower. And the Q, same thing. If it breaks around that 524 and it breaks to 250-day, then we know we're going longer. We're going to go much lower. The ones that people don't look at, traders, is IWM. IWM is very important because if you take a look at IWM, it's been trailing behind the S&P. Give you an example. Here's your IWM. IWM is so important. Okay, there's your IWM. And now if we take a look, let's go take a look at our S&P. You'll see what I'm talking about. If you look at S&P right here, there's your S&P right there. Let me put up 6 months. There you go. There's your S&P. Let me get my IWM back up. And there's the IWM down here. See it? there's your IWM, there's your S&P. See how it's trailing? And then you got the Qs, of course. You see the Qs are up there, okay? And of course our IWM is back down here. That's really tough because IWM has been trying to break out of the 200-day moving average. If it can't break out through that 200-day moving average, we are going to drop, okay? IWM is so important. Now our goals, okay? Now the gold stocks, the miners, the ETF, and our GDX, we've done terrific with these. But now what's happening, they're getting a little weak because money is starting to come out of the gold stocks and starting to go into the bank stocks. But I still think overall, gold's going to make new highs. All right, so as long as we keep a nice trend, upward trend, okay, and we have higher lows, I would hold on to my gold stocks and just make sure I have a nice stop in place, okay? So that's where we are right now, and I hope this helps you, and I hope you subscribe and share and like. But the market right now is at a critical stage, and the one group that they're not watching is your small mid-cap stocks. That is the incredible important. They're the soul and body of the economy. You got to keep your eye on IWM. I know everybody keeps buying the Qs and thinking they're just never going to come down again, but we're starting to see fracture, okay, especially in the Magnificent Seven. We're seeing that. So I hope this helps you a little bit understand what's going on. And again, please subscribe and share. I'd appreciate that. And I'll see you again tomorrow.